All right, let's talk about one of the most fundamental tools every investor needs to know: the price to earnings ratio, or just PE for short. Seriously, if you want a quick gut check on how the market feels about a stock, this is almost always the first place you look. So let's dive right in. At the end of the day, this is the question, isn't it? You're looking at a company, you see that stock price, and you just want to know, am I getting a good deal here, or am I about to get taken for a ride? That simple question is where it all begins. And to get that initial read, that first impression, there's one number that investors and analysts pretty much all turn to first. You can think of it like a financial shortcut, a quick snapshot that helps you cut through all the noise. So, what is this magic number? Well, the best way to think about it is like a price tag. But instead of telling you how much a shirt costs, it tells you how much you have to pay for $1 of a company's profits. And that, my friends, is the price to earnings ratio.
Okay, so here's the more official definition. The PE ratio is simply a metric that takes a company's current stock price and compares it to how much profit it's making for each share that's out in the world. It's all about comparing the price tag to the actual performance.
Now, this is probably the single best way to think about it. If a company has a PE ratio of, let's say, 20, that literally means investors are willing to pay $20 right now for just $1 of that company's earnings. Right away, you get a feel for how expensive or cheap a stock is relative to its actual profits. That sounds pretty simple, right? Well, it is. Let's quickly peek under the hood and see what this thing is actually made of. The formula itself is incredibly straightforward. First up, you've got the P, which stands for price. This is the easy part. It's just the current stock price you see on any financial website. It's what you'd have to pay to buy one share on the open market. Simple as that. The other half is the E, which stands for earnings, specifically earnings per share, or EPS. This one's also pretty simple. It just takes the company's total profit and divides it by all the shares that exist. It basically answers, for each share you own, how much profit is the company making? And putting it all together, it's literally just simple division. You take the price, divide it by the earnings per share, and boom, there's your PE ratio. That's it. No crazy calculus, no complex spreadsheets needed. Okay, so we've done the math. We've got our number. Maybe it's a PE of 15 or 25 or even 50. But what do we do with it? How do we actually translate that number into a useful piece of information? Generally speaking, the rule of thumb is that a lower PE might suggest a stock is a bargain, that it's undervalued. And on the flip side, a really high PE could be a warning sign that the stock is way too expensive. But, and this is so important, it could also mean that investors are incredibly excited about the company's future. They're willing to pay a premium today because they expect massive growth tomorrow. So as you can see, context is everything. This is where comparing companies within the same industry becomes so powerful. Let's look at a quick example. Here we have two energy companies. You've got Marathon Petroleum, or MPC, with a PE over 23. And then you have Hess Midstream, HESM, with a PE of around 15 and a half. Oh, and that little TTM next to EPS, that just means trailing 12 months. So it's based on a full year of actual past earnings. And when you see it on a chart like this, it's crystal clear. To get $1 of profit from Hess, you have to invest about 15 and a half bucks. But to get that same dollar of profit from Marathon, you've got to shell out over $23. Based purely on this number, Marathon's earnings are just, well, they're more expensive. And a quick side note here, you'll often see two different kinds of PE. There's the trailing PE, which is what we just looked at. It uses real earnings from the past. It's based on what actually happened. Then there's the forward PE, which uses analysts' best guesses for future earnings. So one is looking back at facts, the other is looking ahead at expectations. Both are useful, you just need to know which one you're looking at. Now, as great as the PE ratio is for a quick check, it is not a magic wand. It's not a perfect tool. And it has some pretty serious blind spots that you absolutely have to know about before you rely on it. So here are a few of the big ones. First, if a company isn't making any money or it's losing money, you just can't calculate a PE. The math doesn't work. Second, it's pretty much useless for comparing a tech company to, say, a bank. Their normal PE ratios are worlds apart. Also, things like a company's debt level or even some creative accounting can warp the earnings number. This is why you never, ever use the PE ratio in a vacuum.
So because of all those tricky spots, the PE ratio is really just a starting point. It's the thing that opens the door and makes you ask the next question, especially about a company's growth. And that leads us to a really handy evolution of this metric.
And one of the best next steps is called the PEG ratio. What's so cool about this is it directly tackles that big growth question. It takes the PE ratio and then divides it by how fast the company is expected to grow its earnings. This adds that crucial layer of context. A stock might have a high PE, but if its growth rate is even higher, the PEG ratio might show you it's actually a pretty reasonable deal. And that really brings us to the final and most important question. The PE ratio is fantastic at telling you the price the market is charging you for $1 of a company's earnings, but price and value are not the same thing. Is that price actually worth it? Answering that takes more digging, but understanding the PE ratio is always the perfect place to start.